I am Dr. Bina Celine Dorathy. I am an associate professor in Amet Business School, and in this video lecture I am going to explain about the functions of finance. Before we go into the functions of finance, let me give a brief introduction about the significance of finance for business. So, finance is called as the lifeblood of business, and there are two reasons for that. One, it is a basic resource, the other one is it is a central function. So, first let us see why finance is called as a basic resource. To start any business, three important resources are needed. One is called as the material resource, the second one human resource, and the third one is the financial resource, which you see in this slide. So, material resource stands for all the infrastructure that is needed to start a business, like land, buildings, machinery, raw materials, etc. And human resource stands for the people. No organization can function without people. So, human resource is very much essential for the performance of any organization. The third one is the financial resource, which is nothing but money. If you see all these three resources, the third one, financial resource, is more important than the remaining two, because the third one gives access to the remaining two resources, and that is the reason finance is called as the basic resource. Without finance, it is not possible to procure the material resources or the human resource, and this makes finance the most important or a basic resource for any organization. What I said is even more important in a money economy. You can see in this slide, economy can be of two types. One is the barter economy, the other one is the money economy. In a money economy, money is used to exchange for goods. Anything you can, any good you can buy only by using money or through money. But in a barter system, goods are exchanged for goods. So, in a barter system, there is no significance for money. But in a money economy, finance is everything, and it actually commands all other resources. Any manufacturing firm will have these departments, any ordinary manufacturing firm. The first department is the purchase and stores department, the second one is the production, the third one is sales and marketing, fourth is human resource, then of course we have the research and development department, which is R&D, and finally we have the finance department. If you carefully observe the activities of these departments, you will understand how finance facilitates the functions or activities of all these departments. For example, if you take the first department, purchase and stores, the function of that department is buying the materials and other components that are essential for business. So, they place order with the supplier, and they make all arrangements for transportation of the raw material and components from the supplier to the business organization. And the stores department is in charge of storing all the materials and releasing it to the production department as and when required. The production department undertakes all the production functions, and it is responsible for converting the raw material into finished product. And the sales and marketing department is responsible for selling the product, and they also undertake some marketing activities in the form of advertisements and sales promotion. And we have this human resource department, which actually appoints people needed by the organization. So, the department is responsible for appointing the right person for the right job, and not only that, they are also responsible for training the employees and developing the organization, developing the human resource of the organization. Then we have this R&D department, which is very important for a well established manufacturing concern. Not all manufacturing units have R&D, but some of them have R&D, and the particular department is completely engaged in research and development. They undertake lot of research activities to improve the product by finding out, by adding some more features for the product, or coming out with new products according to the changing preference and taste of the customers. So, that is a very crucial department for a manufacturing firm. And if you see this finance department, the last one, the role of finance is to provide the money that is needed to needed for the functioning of all the remaining departments. So, in that way we can say the function of finance is a central function, because all these activities which we just saw has got lot of financial implications. None of the activities can be performed without finance, and that is the reason why it is called as a central function. Now, we shall see the two most important functions of finance. The first one is identifying the sources of finance. We cannot start any business without finance, and whatever be the type of business, there are two sources through which the finance can be procured. One is called as the owned source, the other one is called as the borrowed source. What are the types of owned source and what are the types of borrowed source depends on the form of business, which we shall see in the next slide. These are the most popular three types of business. One is called as the sole proprietorship, the other one is called as the partnership, and the third one is the joint stock companies. A sole proprietorship, as you all know, is nothing but it is owned by a single person. So, for him, owned resource may be in the form of his own savings, and borrowed resources can be borrowings from friends, relatives, and even from banks. So, that is what makes up his borrowed resources. And for a partnership, the owned resource can be the contribution from each and every partner, and the borrowed resources can again be borrowings from banks and other financial institutions that are meant for providing financial support to business organizations. The third most popular form of business is the joint stock company. About the sources of finance for the joint stock company, we will see in detail, because this is the most popular form of doing a large scale business. So, these are the sources of funds for a joint stock company. So, it is divided into owned funds, borrowed funds, and in addition to that we also have one more category called as the internally generated funds. So, we shall first discuss about the owned funds. So, any joint stock company can raise money by issuing shares, and shares are called as the owned funds of a joint stock company, because a shareholder is considered to be the owner of the business. And there are two types of shares, one is called as the equity share and the other one is called as the preference shares. The shareholders are paid a return in the form of a share in the profit, and that is the reason why they are called as the owners, and the share in the profit is called as the dividend. And both equity as well as preference shareholders, they are considered to be the owners of business, but when it comes to treatment, there is a slight difference in their treatment. The preference shareholders are given a preferential treatment as suggested by its name. So, at the time of declaring the dividend, the preference shareholders are declared dividends first, and then only the equity shareholders are declared dividends. In the same way, the preference shareholders are given a fixed percentage of return in the form of dividends, whereas equity shareholders are not given in that way. The dividend for equity shareholder may increase or decrease depending upon the performance of the company, and sometimes when the company is not making any profit or when it is making very low profits, the equity shareholders may have to go without any dividend, they have to sacrifice. But for preference shareholders, there is an option, there is a provision that the dividends which are not paid during certain years can be accumulated and paid during the years of prosperity. Such a advantage is not there for the equity shareholders, and therefore, we can say equity shareholders are the true owners of the business. And then coming to the borrowed funds, a company can raise money externally by issuing a financial instrument called debentures. Even shares are also called as financial instruments, they are also issued in the financial market, and same way debentures, it is another financial instrument which is issued in the financial market, and these debentures are like any borrowing. The person who subscribes to the debenture will be called as the debenture holder, and they are the creditors of the company, and they are paid a fixed rate of interest for the money they are investing into the business, and this interest will be paid irrespective of whether the business makes profit or loss. In addition to debentures, there are other borrowed options like going to the banks for long term borrowings and approaching the financial institutions like IDBI, IFCI, ICICI for long term borrowings, and these borrowings are called as the institutional borrowings. And so these are the two important sources, owned funds and borrowed funds. In addition to that, we have one more called as the internally generated funds. So any business organization, any company over a period of time would have accumulated money in the form of reserves after meeting all its commitments, paying the dividends, paying the interest. Any company over a period of time can accumulate lot of reserves, and these reserves can be reinvested into the business, and that money is called as the internally generated funds. This is one of the most important source of finance for any company, because this is totally free of cost and nothing needs to be paid on this. The second important function of finance is deployment of funds. Deployment stands for investing the money that has been raised. So the first function is identifying the best source of finance and then procuring money from that. The second one is deployment of funds. So under the first function, a finance manager will see what is the best option for the business. A business can raise money through owned source completely, or through borrowed source completely, or through a mix of owned and borrowed source. So it is the finance function which identifies which is the best option, whether everything can be raised through owned resources or through borrowed sources or a mix of owned and borrowed sources. So that is the first function. Then the second one is the raised money will have to be invested into the business. So that is what you call it as the deployment of funds. The money is invested into the business in two ways, through two channels. The first is called as the infrastructure. Infrastructure is creating the infrastructure that is needed to do a business. So this is all about developing the fixed assets. So fixed assets in the form of land, building, machinery, equipments and all those things. They are called as fixed assets, which is marked within the bracket like FA. And any money that is going into creating the fixed asset, it is called as the capital expenditure. In other words, it is called as the capex. This is very important because this creates the basic infrastructure that is needed to start any business. Without infrastructure, without land, building, equipments and other basic facilities, it is not possible to start any business. So the money which goes into this will actually be giving benefit over a period of time, and that is the reason why it is called as fixed assets. All these assets are bound to be with the organization for a longer period of time, and they will be giving benefit to the organization over a period of time. And the next type of deployment of fund is nothing but it is the working capital. So this is nothing but investing money into the business activity. What you see on the slide is the working capital cycle. So this depends on the nature of the organization or the nature of business. The working capital cycle may be a bigger cycle or a smaller cycle depending on what is the product they are manufacturing. So here we can see it starts with cash. So cash, this is the amount that is getting invested into this working capital cycle. So cash gets converted into raw materials. RM stands for raw material. So you buy the raw material with the cash, and then the raw material gets converted into WIP. WIP is nothing but the work in progress, or it is called as the semi-finished goods. So the raw material will have to go through certain processes, maybe process 1, 2, 3 like that, before it is getting converted into work in progress, and the work in progress gets converted into finished goods. FG that you see here is nothing but finished goods. Again, the semi-finished goods, that is work in progress, will have to go through number of processes like 4, 5 and 6, the remaining number of processes before it is getting converted into finished goods. Now these finished goods are sold in the market, and 90% of the business happens on credit basis. So we come across a group of people called as the debtors. Debtors are the people to whom goods are sold on credit. So they buy the goods and then little by little they pay the money. So when they pay the money, you once again get back the cash what you have invested. But what you have to notice here is the money which you are getting back after you complete one cycle should be more than the money what you invested. The difference is the profit. So, that is what is given here. Value addition must be higher than cost, because if you see here, the raw material, when it is converted into work in progress, the value will increase because it is undergoing 1 or 2, 3 processes, and automatically the value increases. For example, the raw material value may be 10,000, but once it completes the first, second, third process, the value may increase from 10,000 to 20,000. So, 20,000 will be the work in progress, and 20,000 worth of work in progress, when it is going through the remaining processes, for example 4, 5 and 6, and it is getting converted into finished goods, then the value will still increase. So, 20,000 worth of work in progress will now get converted into 40,000 worth of finished goods, and when they are sold in the market, they will be sold with a profit. So, 40,000 worth may be sold in the market for 50,000. So, once the cycle is completed, so we started with 10,000 worth of raw material and we end up with 50,000 cash, that is what is generated. So, that is the difference is nothing but it is the profit. So, in a year this cycle can go on repeatedly, one cycle, second cycle, third cycle, like that it can go on repeatedly, and every cycle will result in profit. The more the number of cycles, more will be the profit. And what is the cycle depends upon the nature of the firm. For example, if you take a textile manufacturing unit, the raw material will be yarn for them. Okay, yarn will get converted into fabric, and the fabric will be dyed, okay, and it will get converted into a cloth. The cloth may be stitched and it gets converted into a ready-made garment which is sold in the market. So, it will, for this it may have to go through number of processes like knitting, dyeing and all color and all these things. So, once the process is complete, it becomes a finished product and it is sold in the market. So, every round, every cycle must result in profit. More the number of rounds, more will be the profit. The third important function of finance is accounting. Accounting is basically reporting the performance of a company. So, we have 3 branches of accounting: financial accounting, cost accounting and management accounting. Of the 3, when you talk about finance function, the first one, financial accounting, is more important because that actually reports the financial performance of a company. So, there are 2 financial statements which are used for reporting the financial performance, which we shall see in the coming slides. This is a pro forma of the profit and loss account. There are 2 sides to this. One is the debit side and the other one is the credit side. What you see that side is the debit side and this one is the credit side. So, this actually records all the expenses and the incomes of a business for any given year. So, you can see here the expenses are given here like salaries, rates, taxes, insurance, all these things you see on the debit side, and on the credit side you see the income earned by the business in the form of interest, dividend, rent, etc. So, the difference between the expenditure side and the income side will give you whether net loss or net profit. So, this is a pro forma of the profit and loss account. The second financial statement, most important financial statement, it is called as the balance sheet. The balance sheet reports the financial position of a business as on a given date. Mostly at the end of the year this is prepared, and this gives you the list of assets and liabilities. You can see here on the asset side you find current assets and fixed assets. The liability side you see the current liabilities and long term liabilities, and this is as on a given date, and there will not be any difference between assets and liabilities, because whatever the understanding is whatever assets that has been procured by the business is used up, and there won't be any difference between current assets and current liabilities. The fourth important function is the control function. The performance is measured by using the accounting system. Now, if anything is wrong, it is not according to the plan, then we need to set it right. So, how to do it? That is done through a system called the control system. So, under this control system, the finance function sets a standard for everything, for material, labor and other overheads. These are all expenses of the organization. Each one is an element of cost. These are all costs of the organization. Material is a cost, material cost, labor cost, and overheads are all other expenditures, other indirect expenditures. So, for running an organization, planning is done, budgeting is done, and the standard is set. Okay, and the whatever standard that has been set is compared with the actual performance towards the end of the year. If the actual expenditure is lesser than the standard, then it is considered to be good. Okay, it is positive, and there is nothing to worry, but still they try to improve it. It is revised, the standards are revised and it is further improved. But if the actual expenditures are more than the standard, then it is considered to be a negative situation, and the reasons are analyzed. Why there is a variation from the planned or the budgeted amount? What is the reason? Some corrective measures are taken, and in future also it is prevented. The fifth important function of finance is the advisory role. Finance plays a lot of advisory role for the development of an organization. The first thing is in case of expansion. For example, there is a business unit which is there in Chennai. Suppose they want to start one more unit in Cochin also, then that will come under expansion. So, they have to do lot of analysis for this, whether starting one more unit in Cochin will be viable or not. For this, lot of analysis is needed, and a financial manager is completely responsible for doing this financial analysis and coming out with a judgment. Many times the analysis is in the form of marketing research and finding out who are the competitors there, and whether any product which is going to be introduced by this business into another area, that is Cochin, will be profitable to them or not. So, that will be one kind of market research, will be one way of analysis. Another one is to start a business there, what are all the sources of finance that is needed, and what is the capital market environment, whether it is possible to go for owned source or it is possible to go for borrowed funds, that is taken into account. For example, if they are going to start a unit and another fresh unit, there is already a unit in Chennai and they want to start one more fresh unit in Cochin. For that, if suppose the budget is 10 lakh rupees, then the business has got two options. All these 10 lakh rupees can be raised using the owned source, or it can be raised through the borrowed source. Suppose a financial manager will have to analyze this situation, and suppose it is better to go for owned source, then they may take a decision like to raise this 10 lakh rupees, they can issue 10,000 shares in the market at the rate of 100 each. So, that will be, so this will give them 10 lakh rupees, or else completely they can go for borrowed sources. The entire 10 lakhs can be borrowed from banks or any other financial institution. And even in this case also, if they opt to go for shares, then there is another option here. They can decide whether all this 10,000 shares should be in the form of equity, or it can be in the form of preference also, or a mix of equity and preference, how they want that to be. This analysis is done by the financial manager, and he makes a decision whether it is wise to go for borrowed source or it is better to go for owned source. So, this kind of analysis is done by him, because both has got its own positive and negative impact. We need not always think like owned source is better compared to the borrowed source. In case of owned source also, there are some negative things. For example, if you go for a owned source, you either end up creating equity shareholders or preference shareholders, and these shareholders, they have they are the stakeholders, they have a right in the decision making process of the organization. They attend the meetings, and they, in particularly the equity shareholders, they have voting rights, they attend the meeting, and they have every right to interfere into the decision making activity of the organization. So, sometimes they may change the direction of the business also. So, it is not always good to go for owned source and going on increasing the number of equity or the preference shareholders. Another negative thing about them is once you go for equity shares or preference shares, you may have to pay them dividends out of the profit. So, the and it is for a long period of time. You may have to every year pay a part of your profit in the form of dividends to them. So, that is the negative side of going to the owned source. And for short term requirements, it is not wise to go for owned sources. Only for long term requirements you can opt for owned sources. But in case of borrowed source, though the only negative thing about borrowed source is whether the business makes profit or loss, definitely it will have to pay the percentage of interest on the borrowed source. That is the negative point attached to borrowed source. But the good thing about borrowed source is you can borrow for a short period of time, and whenever you get money you can repay and you can close the particular loan. That kind of flexibility is there. Whereas owned source, that much of flexibility is not there. It is somewhat rigid compared to the borrowed sources. So, this is the analysis which is done by a financial manager. So, when a company wants to go for expansion, they want to start one more unit elsewhere, then they have to, first thing is identify what are all the sources of finance to start that new unit. So, for doing that, someone has to do this analysis, and it is usually done by the financial manager. And in the board meeting, he comes out with a lot of options, suggestions, and actually directs the company whether to go for expansion or not. And the second advisory role that is done by the finance function is case of acquisitions. Acquisition is nothing but taking over other companies, okay, joining hands with other companies, taking over other companies. So, this is one way to cut down competition. Okay, instead of competing with the competitors, one good strategy to overcome competition is to take over the business, is to join hands with the competitors. But again, when you take over business, there are a lot of financial things that needs to be worked out. Okay, so we have to actually see what is the financial status of that firm, what are all the what is the profitability of the firm, what is the balance sheet, what is the status of finance of that firm, and whether this acquisition will be good for the firm or whether it will be a positive one or a negative one. This is again analyzed by the financial manager, and it comes under it is an advisory role of finance. Then the third one is moving into diversification. Diversification is moving into different types of related products, and it is always best to diversify product. It is one of the strategies that is used to compete in a market. So, instead of always marketing the same product, slightly diversifying, moving into different areas is always good to compete in a market. And this diversification is again a crucial decision. Sometimes diversification will work out, it will give positive results. Sometimes it may not work out, it may not give the expected results. So, whether diversifying, moving into other related areas will be profitable or not will have to be worked out by the financial manager. Again, it has got lot of financial implications. Expansion, acquisition, diversification, all these things have lot of financial implications, and without the advice of financial manager, it is just not possible to do that. And the last one is pricing. Last one is pricing the product. So, it is a very crucial decision. You cannot just like that price the product. So, normally it is said like cost plus profit is equal to price. Cost plus profit is equal to price, but this cannot be followed as it is. Okay. Many times if the cost is 100, then if they aim for a profit of 10 rupees, the price then it becomes 110. But if there is a competitor in the market who is offering the same product for 100 rupees, then it is not possible to follow this formula that is written on the board. When a competitor is offering the same product for 100 rupees, you cannot offer the product for 110 rupees, because there won't be any demand for the product. So, we have to reduce this, reducing in the sense you cannot always be compromising with the profit. That is not good for a company in the long run. So, the best way to find out what is the cost and actually reduce the cost. This is where what we saw as the fourth one, the control function comes here. So, this is where there are three elements of cost. One is the material, the other one is the labor cost, and the third one is the overheads. The first two are called as the direct expenses. This one overheads, they are taken as the indirect expenses. The first two are called as the direct expenses because they directly increase or decrease with output. Material stands for the raw materials. The more you produce, the material expenses will be more. The lesser you produce, material expense will go down. So, it directly varies with output. Similarly, labor. Labor cost is nothing but the wages paid to the workers. The more you produce, you need more workers and you pay them more. Less you produce, you need less workers and you pay them less. These two material cost as well as the labor cost, these two costs directly vary with production, and therefore, they are called as the direct expenses. Whereas, overheads are all the indirect expenses and they do not vary directly with the output. Now, coming to setting standards, for every element of cost, a standard is set. For example, to produce 10,000 units of a product A, what is the material needed and how much should be the labor cost and how much should be the overheads. The standard is set. So, for example, if 100 to produce 10,000 units of A, the expense, material expense should be, for example, 5,000, and labor should be around 7,000, and other overheads must come to another 4,000. So, totally it should not be more than this. So, total should be 16,000. So, after the production process is over, the actuals are compared. Once the production process is over, we get the actuals. So, actual expenditure. Suppose the actual expenditure for material is less than 5,000, this is called as favorable. Okay, we actually had a plan to control it, and that it should be well within 5,000. Now, if it is within 5,000, then this situation is called as favorable. Suppose if it is more than 5,000, then it is adverse. Here we mark it as favorable F, and here we call it as adverse. In case of favorable, it is taken as positive, and there is nothing to worry about that. But in case of adverse, they see what is the reason why it is more than 5,000 and they try to take measures to bring it down. The same way it happens for all the other expenses also, all these other costs, labor and overhead. So, this is where we see the role of finance, setting these standards and trying to reduce, bringing the price of the product down without compromising the profit. So, we have seen the functions of finance, which is the life and blood of any organization, most crucial. So, in any business, whether it is a profit oriented business or a non-profit business, it cannot function without finance. Any activity will definitely have financial implications, and understanding the role of finance, understanding the functions of finance for any business is crucial. I hope this would have been helpful to you. Thank you.